Greetings and welcome to my channel. I haven't been creating much lately for some reasons I'm not going to go into here, but I've been very busy. This is the first of some shorter videos I'm going to do on some financial topic that sparked my interest, and this first video is going to be on I-bonds. For those who don't know, I-bonds are issued by the U.S. Treasury and have both a fixed rate and an inflation rate. I purchased some I-bonds back in 2004 and 2005 to diversify my portfolio. As you can see, the fixed rate and the inflation rate are adjusted in November and May of each year. First, looking at the fixed rates, you'll see that lately they've been 0% and they never get much higher than that. You'll see there's a 0.5% and then back at 0% in 2013, 2012, back up to 1.2% November 2007. The ones I purchased were at 1% in 2004 and 2005. And then if you were able to purchase them when they first started issuing I-bonds back in the late 90s, the fixed rate was as high as 3.6%. You'll see May 1st, 2000. The inflation rate is the real interesting part of I-bonds. Here's the inflation rate. Now you'll notice the first one here, November 1st, 2021, is at 3.56. So you double that, you have 7.12%. And that's what people are interested in lately, is that high percentage guaranteed return. Unfortunately, it adjusts every 6 months. I expect the next one to be fairly high. I don't think they've set the value yet, but maybe they have. We'll know in the minimum, we'll know in a couple weeks. But anything you purchase now is going to have that fixed rate or the inflation rate of 3.56. And the fixed rate is currently 0%. So the total 6-month rate is 3.56%, or the annual is 7.12. And actually they show that later on. But you also notice that there are some years and some periods where the inflation rate was negative. So I have a negative 0.8% in May of 2015, and there's also a negative 2.78% in May of 2009. Now that'll never reduce the combined rate to below 0%. So in my case, the base rate or the fixed rate was 1%. So that period starting in May of 2009, they started earning 0% because it negated my 0% rate, or my 1%, took it all the way to 0, but they'll never let it get below 0. So you're guaranteed to not have a negative interest rate. And then the last chart down here, they actually have the composite rate. The composite rate shows that if you purchased your bond from November of last year to April of this year, the composite rate is 7.12%. So currently, since it's 3.56, anything will have that 3.56 added onto it. So bonds you purchased last year from May to October still have that base rate of 0, but they adjust to 3.56 for the 6-month period. So they'll always have the latest inflation rate added in as part of their composite. I'll show you the composite calculation here in a second. But if we go all the way down to the ones I purchased back in 2004, 2005 that have the 1% base rate, they have an 8.16% composite rate. So currently my bonds are earning 8.16%. Here's how they calculate the composite rate. So this would be for current bonds issued between November of 2021 and now. And that happens to be 7.12%. The fixed rate being 0% up here. The semi-annual inflation rate is 3.56%. And what they do is they add the fixed rate to 2 times the semi-annual inflation rate. And then they add the fixed rate times the semi-annual inflation rate. Since it's 0, they're just adding 0. You'll notice here we have 0 plus 0.0712 or 7.12% plus 0. So we get a composite rate of 7.12%. In the case of my bonds that are earning 1%, this value would be 1, and then this, because it's 1%, would be 0.000356, which would round to 0.0004, and you would add that, and I would get, well, that wouldn't, the 1 would be here. So I would add those together. I would get 0.0816. So that's where they get the 816 instead of 812, because they add this small amount here, which is kind of takes, it's like a small compounding factor, because it's a slightly, you're going to get a slightly higher rate than just 8.12%. I was originally going to sell my I bonds this year as part of my early retirement plan to help provide income for, you know, the shortfall I had between my pension and my expenses. Once I saw the rates, I decided that I would continue to use cash for now, since my cash is actually losing value with inflation being so high at the moment. So it made sense to keep the I bonds. Once inflation returns to normal, then I will probably go ahead and cash these out. I understand some people are chasing yields, and we haven't seen government bonds with this level of return in a long time. You should be aware that the fixed rate has been at or near 0% since May of 2008. Bonds purchased now, before May 2022, have a base rate of 0%. The fixed rate might change in May, but we'll see. Either way, unless inflation remains high, which hopefully it doesn't, the combined rate could still return to near 0. Additionally, there are limits on how much you can invest in I bonds. You'll see that in one calendar year, you can purchase up to $10,000 in electronic I bonds at Treasury Direct, an additional $5,000 in paper I bonds using your federal income tax refund. So the limits are pretty small if you have a significant amount of money. For me, this was not an issue. I was able to buy all I wanted because I couldn't afford a whole lot at the time anyway. And I would still never probably purchase this amount, even if I wanted to. I hope you learned something from this short video. Let me know if you like this format, and if you're going to retire, retire to something.